Gold is trading right now at $5,068 per ounce. Let that number sit for a second. 5,068. Just days ago, this market was fighting to stay above the 4,900 zone. Today, it's hovering above 5,000 like it belongs there. This is not a normal price discovery process. This is not healthy inflation hedging. This is not retail enthusiasm. This is what happens when institutional fear quietly replaces institutional confidence, and the market starts repricing risk faster than the public can understand. When gold moves like this, at this speed, in this zone, history tells us one thing very clearly. Something underneath the global financial system is cracking, and the people who know about it are already positioned. Most people watching this think they're late. They think gold already ran. They think this move is emotional. They think this is the top. That mindset is exactly how retail gets trapped at every major regime shift. Because gold does not cross $5,000 because of YouTube thumbnails or news headlines. Gold crosses 5,000 when trust evaporates. Trust in currencies, trust in policy, trust in forward guidance. This price is not excitement. It is a warning signal. Subscribe to the channel. Let's start the video. Right now, the mainstream explanation is comfortable and clean. They'll tell you gold is rising because inflation is sticky. They'll tell you it's because of geopolitical tensions. They'll tell you it's because investors want diversification. That narrative is designed to keep you calm. The real story is far more uncomfortable. Gold is moving because the global system is entering a phase where liquidity matters more than credibility, and central banks are losing their ability to control expectations. When expectations break, price explodes. That is exactly what you're witnessing between $4,900 and $5,068. Let's start with interest rates, because this is where everything begins and ends. Officially, rates are higher for longer. Unofficially, the bond market has already rejected that story. Long-dated yields are no longer responding to central bank threats. They're responding to debt saturation. Governments are issuing more debt than markets can absorb without intervention. When that happens, rates stop being a tool and start becoming a liability. Gold thrives in that environment because it is not someone else's promise. It does not require confidence in a committee. It only requires recognition. Now layer on top the currency problem. The US dollar still dominates, but dominance does not mean stability. It means responsibility. And the system is buckling under that responsibility. Trade is fragmenting. Settlements are diversifying. Reserves are being quietly reallocated. No press conferences. No official announcements. Just flows. Gold is not replacing the dollar overnight. That's not the point. Gold is being used as neutral collateral in a world where trust between blocks is eroding. That shift does not show up in headlines. It shows up in price. Then comes geopolitics. Not as a shock event, but as a constant pressure. Energy routes are unstable. Shipping lanes are weaponized. Sanctions are no longer rare. They're routine. When risk becomes permanent instead of temporary, markets stop discounting it and start embedding it. Gold is the only asset that benefits when uncertainty becomes structural. That's why this move does not fade easily. That's why dips are shallow and violent selling gets absorbed. Now, let's talk about the most important part, the $4,900 level. This zone is the foundation of the entire move. It was tested, it was pressured, it was doubted. And every time price came into that range, buyers stepped in quietly. No celebration, no spike in volume, just absorption. That is not retail behavior, that is balance sheet behavior. Funds building positions do not chase breakouts, they defend levels, and $4,900 was defended with conviction. Above $5,000, the psychology of the market changes completely. Risk managers who were comfortable being underweight gold are suddenly uncomfortable. Portfolio managers who ignored gold are forced to explain why. Allocations that were symbolic become material. This is not FOMO, this is compliance buying. That's why moves above psychological levels often accelerate instead of reversing. At $5,068, gold is sitting in a zone where liquidity is thin and reactions are exaggerated. This is where volatility expands. That does not mean the trend is over. It means the market is searching for equilibrium at a higher altitude. And equilibrium is never found in a straight line. Pullbacks will happen, sharp ones, emotional ones. But context matters. The first zone everyone should be watching is $5,020 to $4,980. If gold pulls back into this area and stabilizes, that confirms strength. That tells you buyers are no longer waiting at $4,900. They're willing to pay higher prices to get exposure. That is bullish, even if it feels uncomfortable. A deeper pullback toward $4,900 would be even more revealing. If price revisits that level and holds again, it confirms that the entire move higher was not speculative, or it was structural. That's where institutions reload. That's where long-term capital commits. That's where narratives change quietly before prices do. Only a decisive break and sustained hold below $4,900 would force a reassessment. And right now, there is no evidence of that. There is no panic distribution. There is no volume spike signaling exit. There is only rotation, rebalancing, and positioning. Here is the mistake most people make. They ask, how high can gold go? That question belongs to the wrong phase. The correct question is, what broke that made this price necessary? Because gold at 5,068 is not a prediction. It's a response. A response to debt, a response to policy exhaustion, a response to a system that requires constant liquidity injections to function. This is why central banks themselves are buyers, not traders. Buyers. They understand that in a world where balance sheets never shrink, hard assets become strategic, not speculative. They don't care about short-term pullbacks. They care about long-term trust. So what do you do right now? You do not chase green candles. You do not fade strength just because price feels high. You respect levels, not emotions. Watch $5,020, watch $4,980, watch $4,900. As long as gold holds above this structure, the trend remains intact. Volatility is noise. Structure is truth. Gold is no longer trading like a metal. It's trading like a confidence barometer. And confidence, once lost, does not return quietly. This move is not over because the reason for it is not resolved. The system is still stretched. Debt is still compounding. Policy credibility is still fragile. Gold at 5,000 is not the end of a story. It's the beginning of a new chapter, and the people who understand that won't be loud about it. They'll already be positioned.